If you've ever jumped into a trade too early, watched it run against you, and then seen it turn in your original direction right after you got stopped out, you know that sinking feeling. And if you've been trading for a while, you've probably asked yourself, how do these people always get those perfect entries? Well, here's the truth. Perfect entries aren't magic, and they're not luck. They're the result of a process, a repeatable process that removes the guessing and replaces it with precision. And today I'm going to break down exactly how I get sniper precision entries using ICT concepts so clean it feels like the market was waiting for me to click buy or sell. Before we get into the actual method, I need to explain why most traders never get those perfect entries in the first place. They're reactive. They see price moving and their brain tells them it's going, don't miss it. And boom, they're in. No bias, no plan, just FOMO. The problem, if you enter late, you instantly ruin your risk toward, and you're usually buying someone else's take profit or selling into someone else's buy limit. The market isn't random. It hunts for liquidity before making the real move. So the first step to clean entries is simple. Stop reacting to price. Start making price react to you. You plan your entry in advance and you let the market come to your level. Step 1, higher time frame bias. The foundation of every perfect entry starts here, your HTF bias. If you're not starting on the daily 4H or 1H chart, you're trading in the dark. I start by asking myself 3 questions. Number 1, where is the liquidity? Number 2, are we in premium or discount relative to the range? And number 3, what's the market structure? Are we bullish, bearish, or consolidating? If I see we're in premium inside a bearish weekly range, I'm only looking for shorts. That decision alone eliminates 50% of bad trades. HTF bias is like knowing the weather before you leave the house. You don't wear shorts in a snowstorm, and you don't look for longs in a bearish premium range. Step 2, wait for liquidity to be taken. Here's the part most traders skip. They try to enter before liquidity is taken. That's why they get faked out. The market moves from liquidity pool to liquidity pool. That means before the real move, there's usually a manipulation phase, a stop hunt. I look for equal highs, equal lows, or obvious swing points where traders have clustered stops. For example, if price has been respecting the level all week, you can bet money there are stop orders sitting just above or below it. That's the bait. Once that liquidity is taken, that's when I get interested. Not before. If you enter before liquidity is cleared, you're basically volunteering to be liquidity. Step 3, refine the lower time frame confirmation. Now this is where we shift from sniper positioning to sniper execution. Once liquidity is taken in my bias direction, I drop to a lower time frame, usually 15 minutes or even 5 minutes charts. Here's what I'm looking for first, a market structure shift in my direction. If I'm short, I want to see a clear break of structure to the downside after the liquidity grab. Second, a fair value gap or an order block forming right after that shift. That's my high probability entry zone. Third, an OTE retracement into premium for shorts or into discount for longs. This is how you stack confluences. I'm not entering just because we swept liquidity. I'm entering after a structural shift in the right zone with an imbalance for price to trade back into. Step 4, execute like a sniper. Perfect entries are precise. I'm not using wide stops that cover just in case. My stop loss goes right beyond the wick that grabbed liquidity. If the setup is real, price won't come back there. If it does, my trade idea is invalid. My take profit is the next logical liquidity pool or opposing imbalance. And risk, I don't risk more just because it looks perfect. I stick to my fixed percentage, usually 0, 5% to 1% per trade. That's how you stay consistent. Let me give you a real example. Last week, NQ was in a bearish HTF range. Price was in premium, forming lower highs. On Wednesday, London session swept equal highs above Tuesday's peak. That was my liquidity grab. I dropped to the 15 minutes chart, saw a clean break of structure down with a fair value gap, lining up perfectly with a 62% OTE retracement. I entered short from 18,145, stop above the high at 18,155, and targeted the sell side liquidity at 18,095. No drawdown, straight to target. That's a textbook sniper entry, all because I waited for HTF bias, liquidity grab, and LTF confirmation to line up. Common mistakes that kill perfect entries. Here are the mistakes that ruin otherwise perfect setups. 1, jumping in before confirmation. You see a sweep and think that's enough. It's not. 2, ignoring HTF bias because the LTF looks good. Remember, the lower time frame will always give fake signals against the higher trend. 3, trading during low liquidity hours. Sniper entries happen in active sessions, London and New York. And 4, moving your stop loss just because you don't want to lose. Snipers don't flinch. Here's the big takeaway. Perfect entries aren't about predicting every candle. They're about waiting for the exact conditions that give you the highest probability of being right. If you only take trades where HTF bias liquidity sweep and LTF confirmation agree, you won't need to guess anymore. So stop chasing, stop forcing trades, and start making the market come to you. Because once you master this, every entry you take will feel clean, confident, and controlled. Trade safe, stay patient. Peace.